Chapter 38. Analyzing Investments. The numbers tell a story, my rich dad would say. If you can learn to read financial statements, you can see what is happening within any company or investment. My rich dad taught me how he used financial ratios to manage his businesses. Whether it is an investment in the stock of a company or purchase of real estate, I always analyze the financial statements. I can determine how profitable a business is, or how highly leveraged a business is, just by looking at its financial statements and calculating financial ratios. For a real estate investment, I calculate what the cash-on-cash return will be, based on the amount of cash I need to spend for the down payment. The bottom line always comes back to financial literacy. This chapter will cover some of the important concepts and thought processes every sophisticated investor goes through in choosing investments for their financial plan, financial ratios of a company, financial ratios for investing in real estate, natural resources, good debt or bad debt. BT, investing and saving, financial ratios of a company. Gross margin percentage is the gross margin divided by sales, which tells you what percentage of sales is left after deducting the cost of goods sold. The gross margin is sales minus the cost of goods sold. Rich Dad would say, if the gross isn't there, there'll be no net income. How high the gross margin percentage needs to be depends on how a business is organized and the other costs it has to support. After calculating the gross margin percentage, Rich Dad's convenience stores still had to rent the building, pay the clerks, the utilities, the taxes and government permit fees, pay for wasted or damaged goods and a long list of other expenses. Then they had to have enough left over to give Rich Dad a good return on his original investment. For internet e-commerce sites today, these additional costs are usually much lower, so these businesses can afford to sell and make a profit with a lower gross margin percentage. The higher the gross margin, the better. Gross margin percentage equals gross margin, sales cost of goods sold, divided by sales. Net operating margin percentage tells you the net profitability of the operations of the business before you factor in your taxes and cost of money. BIT stands for earnings before interest and taxes, or sales minus all costs of being in that business, not including capital costs, interest, taxes, dividends. The ratio of EBIT to sales is called the net operating margin percentage. Businesses with high net operating margin percentages are typically stronger than those with low percentages. The higher the net operating margin, the better. Net operating margin percentage equals EBIT divided by sales. Operating leverage is the percentage of fixed costs in a company's cost structure. It can be calculated by dividing contribution by fixed costs. Contribution refers to the gross margin, sales less cost of goods sold, minus variable costs, all costs that are not fixed costs that fluctuate with sales. Fixed costs include all sales, general, and administrative costs that are fixed and do not fluctuate based on sales volume. For instance, the labor costs related to full-time employees and most costs related to your facilities are generally considered fixed costs. Some people refer to this as overhead. A business that has an operating leverage of 1 is generating just enough revenue to pay for its fixed costs. This would mean that there is no return for the owners. The higher the operating leverage, the better. Operating leverage equals contribution divided by fixed costs. Financial leverage refers to the degree to which an investor or a business uses borrowed money. Total capital employed is the book or accounting value of all interest-bearing debt, leave out payables for goods to be resold and liabilities due to wages, expenses, and taxes owed but not yet paid, plus all owners' equity. So if you have $50,000 of debt and $50,000 of shareholders' equity, your financial leverage would be 2, or $100,000 divided by $50,000. Financial leverage equals total capital employed, debt plus equity, divided by shareholders' equity. Total leverage is the total risk that a company carries in its present business. Total leverage tells you the total effect a given change in the business should have on the equity owners, common shares or general partner. Total leverage is calculated by multiplying the operating leverage by the financial leverage. If you are the business owner, and therefore on the inside, your company's total leverage is at least partly under your control. If you are looking at the stock market, total leverage will help you decide whether or not you want to invest. Well-run, conservatively managed, publicly traded, American companies usually keep the total leverage figure under 5. Total leverage equals operating leverage multiplied by financial leverage. Debt-to-equity ratio measures just that, the portion of the whole enterprise, total liabilities, financed by outsiders in proportion to the part financed by insiders, total equity. Most businesses try to stay at a ratio of 1:1 or below. Generally speaking, the lower the debt-to-equity ratio, the more conservative the financial structure of the company. Debt-to-equity ratio equals total liabilities divided by total equity. Quick and current ratios tell you whether or not the company has enough liquid assets to pay its liabilities for the coming year. If a company doesn't have enough current assets to cover its current liabilities, it is usually a sign of impending trouble. On the other hand, a current ratio and quick ratio of 2:1 is more than appropriate. Quick ratio equals liquid assets divided by current liabilities. Current ratio equals current assets divided by current liabilities. Return on equity is often considered one of the most important ratios. It allows you to compare the return this company is making on its shareholders' investments compared to alternative investments. Return on equity equals net income divided by average shareholders' equity. What do the ratios tell me? Why Rich Dad taught me to always consider at least 3 years of these figures. The direction and trend of margin percentages, leverages, and returns on equity tell me a lot about a company and its management, and even its competitors. Many published company reports do not include these ratios and indicators. A sophisticated investor learns to calculate these ratios, or hires someone knowledgeable to do so, when they aren't provided. A sophisticated investor understands the terminology of the ratios and can use the ratios in evaluating the investment. However, the ratios cannot be used in a vacuum. They are indicators of a company's performance. They must be considered in conjunction with analysis of the overall business and industry. By comparing the ratios over at least a 3-year period as well as with other companies in the same industry, you can quickly determine the relative strength of the company. For example, a company with excellent ratios over the last 3 years and strong profits could appear to be a sound investment. However, after reviewing the industry, you may find out that the company's main product has just been rendered obsolete by a new product introduced by the company's main competitor. In this instance, a company with a history of strong performance may not be a wise investment due to its potential loss in market share. While the ratios may appear complicated at first, you will be amazed at how quickly you can learn to analyze a company. Remember, these ratios are the language of a sophisticated investor. By educating yourself and becoming financially literate, you too can learn to speak in ratios. Financial ratios for investing in real estate. When it came to real estate, Rich Dad had 2 questions. 1. Does the property generate a positive cash flow? 2. If yes, have you done your due diligence? The most important financial ratio of a piece of real estate to Rich Dad was his cash-on-cash return. Cash-on-cash return equals positive net cash flow divided by down payment. Let's say you buy an apartment building for $500,000. You put $100,000 down and secure a mortgage for the $400,000 balance. You have a monthly cash flow of $2,000 after all expenses and the mortgage payment are paid. Your cash-on-cash return is 24% or $24,000, $2,000 multiplied by 12 months, divided by $100,000. Before buying the apartment building, you must decide how you will purchase it. Will you buy it through a C corporation, an LLC, or a limited partnership? Consult with your legal and tax advisors to make sure that you choose the entity that will provide the most legal protection and tax advantages to you. Due diligence. In my opinion, The words due diligence are some of the most important words in the world of financial literacy. It is through the process of due diligence, the careful evaluation of a potential investment to confirm all material facts, that a sophisticated investor sees the other side of the coin. When people ask me how I find good investments, I simply reply, I find them through the process of due diligence. Rich Dad said, the faster you are able to do your due diligence on any investment, regardless of whether it is a business, real estate, a stock, or bond, the better able you will be to find the safest investments with the greatest possibility for cash flow or capital gains. Once you have determined that a piece of real estate will generate a positive cash flow, you still need to perform due diligence on the property. Rich Dad had a checklist that he always used. I use a due diligence checklist as well. It is very thorough and includes items that did not exist years ago, such as Phase I environmental audit. If I have questions about the property, I often bring in the experts and have my attorneys and accountants review the deal. Due diligence checklist. 1. Current rent roster with paid-to dates. 2. List of security deposits. 3. Mortgage payment information. 4. Personal property list. 5. Floor plans. 6. Insurance policy, agent. 7. Maintenance, service agreement. 8. Tenant information, leases, ledger cards, applications, smoke detector forms. 9. List of vendors and utility companies, including account numbers. 10. A statement of structural alterations made to the premises. 11. Surveys and engineering documents. 12. Commission agreements. 13. Rental or listing agreements. 14. Easement agreements. 15. Development plans, including plans and specifications and as-built architectural, structural, mechanical, electrical, and civil drawings. 16. Governmental permits or zoning restrictions affecting development of the property. 17. Management contracts. 18. Tax bills and property tax statements. 19. Utility bills. 20. Receipts and disbursements journals pertaining to the property. 21. Capital expenditure disbursement records pertaining to the property for the past 5 years. 22. Income and expense statements pertaining to the property for 2 years prior to the submission date. 23. Financial statements and state and federal tax returns for the property. 24. A termite inspection in form and content reasonably satisfactory to the buyer. 25. All other records and documents in seller's possession or under seller's control which would be necessary or helpful to the ownership, operation, or maintenance of the property. 26. Market surveys or studies of the area. 27. Construction budget or actuals. 28. Tenant profiles or surveys. 2. 9. Work order files. 30. Bank statements for 2 years showing operating account for property. 31. Certificates of occupancy. 32. Title abstract. 33. Copies of all surviving guarantees and warranties. 34. Phase I environmental audit, if it exists. Natural resources. Many sophisticated investors include investments in the Earth's natural resources as part of their portfolio. They invest in oil, gas, coal, and precious metals, just to name a few. My rich dad strongly believed in the power of gold. As a natural resource, gold has a limited supply. As rich dad told me, people throughout the centuries have cherished gold. Rich dad also believed that owning gold attracted other wealth to you. Good debt or bad debt. A sophisticated investor recognizes good debt, good expenses, and good liabilities. I remember rich dad asking me, how many rental houses can you afford to own where you lose $100 per month? I, of course, answered, not too many. Then he asked me, how many rental houses can you afford to own where you earn $100 per month? The answer to that question is, as many as I can find. Analyze each of your expenses, liabilities, and debts. Does each particular expense, liability, or debt apply to a corresponding income or an asset? If so, is the cash flow coming in from the income or asset greater than the cash flow going out for the expense or liability or debt? For example, a friend of mine, Jim, has a mortgage on an apartment building for $600,000. He pays out $5,500 each month in mortgage and interest payments. He receives $8,000 rental income each month from his tenants. After all other expenses, he has a net positive cash flow of $1,500 each month from that apartment building. I would consider Jim's mortgage a good debt. Investing and saving. A sophisticated investor understands the difference between saving and investing. Let's look at the case of two friends, John and Terry, both of whom believe themselves to be sophisticated investors. John is a highly paid professional and invests the maximum in his 401k retirement plan at work. John is 42 and has $250,000 in his 401k plan already because he has been adding to it for 11 years. There is no return, or cash flow, from it until he retires. Then it will be fully taxable at his ordinary earned income rates. Following are John's details, assuming an average tax rate of 35% and a commonly assumed return on investment of 8% annually, although the return can actually be substantially less. Income $100,000 salary, taxes 35%, investment, 401k retirement plan. Maximum 15% contribution $15,000, retirement plan return 8%, cash flow from investment none. Terry is the same age as John and makes a similar salary. She has invested in a series of real estate deals over the past 11 years and just put $250,000 down on a $1 million property. Terry is earning a cash-on-cash return of 10% and expects a conservative appreciation of her property of 4% per year. When she retires, Terry expects to 1031 exchange into another property to take advantage of the high equity and cash flow. Terry has never contributed to a 401k plan. Terry's details are as follows. Income $100,000 salary, taxes 35%, investment, real estate $1 million property, down payment 25% or $250,000, real estate return 10% cash on cash per year, annual appreciation 4%, cash flow from investment $25,000 per year. The following chart shows the asset accumulation, annual after taxes cash flow available for spending, and the annual retirement cash flow, also after taxes, for both John and Terry. Pause the video, refer this image for better knowledge. As you can see, Terry's family will be able to spend almost $10,000 more per year than John's family, each and every year for the first 20 years. Then they can both retire at age 62, having each worked 31 years. At retirement, John begins drawing out 8% of his accumulated 401k plan, receiving $118,100 per year after taxes, $157,400 before taxes. He plans to withdraw none of the principal amount. After 31 years of investing $15,000 each year in his plan, he succeeded in replacing 150% of his work income. Even though Terry only put $250,000 down on the property, she benefited from the 4% appreciation on the total $1 million value of the property. During the 20 years, the rental income from the property paid off the mortgage of $750,000, so when Terry retires, she can roll over the complete equity of $1 million into a much larger property, worth $8,892,000 according to these calculations. This new property will generate a cash flow of $342,700 per year for Terry. While John's retirement will be comfortable, Terry's will be much richer. If, for some reason, John needs more income in retirement, he must start drawing out the principal from his retirement plan. Terry would only need to do another tax-free exchange into other buildings to capture the mortgage principal paid down by her tenants, leveraging that into higher income. John's example will have taught his children to go to school, get good grades, get a good job, work hard, and invest in their retirement plan regularly to be comfortable in retirement. Terry's example will have taught her children that if they learn how to invest by starting small, minding their own business, and keeping their money working hard for them, they'll be rich. It is easy to see that investing in a building generated much more cash flow and income for Terry than saving in a 401k did for John. I would categorize Terry as an investor, and John as a saver. Sophisticated investors understand the difference between investing and saving and generally have both as part of their financial plan. For Rich Dad Poor Dad audiobook, click on top right corner. And for Rich Dad Poor Dad audiobook playlist, find the link in description. Thank you for giving your valuable time for this video. We hope you learned something new today. Stay tuned for our next videos. Hey, don't forget to subscribe, like and share this video to your friends. And turn on bell notification for our updates.